I think AI is going to bring winners and losers among allocators. Those that don't adopt it very quickly, I'm thinking about those with maybe some hurdles at the state level specifically, are going to be left out, because if Fortress, for example, calls like your local state and says, we've got a great co-investment deal, but you got to tell us in 2 days, theoretically, someone can do 90% of the work on that at some point and get in 2 days, and then someone else who hasn't adopted those or learned how to use them will be cut out. So I think you're going to see a K-shaped LP happening like pretty quickly.
We are back. For those of you who don't know me, I'm Shannon Murphy. I am the head of research at iConnections, and I was saying to somebody during lunch, it feels like every time iConnections has an event this year, there's some sort of natural disaster or act of God. In February, it was the worst blizzard in about a decade. Now it looks like hopefully we'll have a positive one with the Knicks winning, we'll see. So I guess stay tuned for whatever happens in Singapore. I am really delighted to be moderating this panel. And it's very exciting to talk about where institutional money is going. When we had our prep call, I was thinking these panelists represent some of the biggest tectonic plates in alts. And we're going to do a little bit of a journey from the thematic to more specific about what is really exciting them, giving them pause in places they want to dig in further. So maybe, Elizabeth, I'll start with you. You have been, pretty clear and interesting. You don't think inflation is transitory. Can you talk a little bit about why that matters and how that's what the implications for portfolios are?
Yeah, so I will highlight that I was on an episode of Wall Street Skinny, and the day before, that day, this is like a month ago, I said inflation was going to calm down. So I changed my opinion within a day. But I can tell you why I changed my opinion on that. So if you've heard me speak at a conference before, I usually talk about the money supply and inflation. It's like the majority of what I focus on, both when I was in an allocator and now on the other side of the table. But watching, so like 2026 inflation is maybe an Iran problem, but 2027 is a money supply problem. If you look at M2, which the Fed admits that it does not take into account the money supply, it has been increasing at a 7% rate over the last 3 months annualized. So I know any GPs in the audience, you can't annualize your daily numbers, and I'm effectively doing that, but whatever. So if that's increasing, and we've got the velocity of money increasing, so GDP basically divided by M2, that historically has led to periods of higher inflation. And we can argue about the 1990s and why that didn't happen all day long. You can meet me after. I'm happy to debate that with you. But essentially, that means more money chasing more goods, which generically means that there should be inflation. And having run an institutional portfolio, inflation is very impactful, and it's something that really matters. And so you need to be looking for things that you think can protect you in that environment. And a lot of times, we believe that equities can protect in those sorts of environments. I would argue that you may need to look more places this time around. So no one's going to believe me because now I work at Fortress, but I would say floating rate credit would be one of those places to look. Outside of that, I think a lot of smart investors have been looking at increasing diversification through gold and other real assets.
One of the other huge themes, obviously, that we can't get really away from is AI, and I think Anthropic publicized that they released Safe Mythos during our lunch as well. Justin, I want to get your perspective on specifically that theme, where there is too much hype and maybe where there's frankly not enough hype.
Yeah, it's a great question. We tend to think about artificial intelligence as both an opportunity and a risk to client portfolios. We also subscribe to so-called Amara's law, in that we think that people tend to underestimate the long-term impact of technological waves, but overestimate the impact of technological waves short-term. And we think we might be witnessing some of the same. So an overinvestment and some of the infrastructure we're being very careful about, but also trying to position ourselves where we can have exposure to the long-term winners. And so what that means is that we are very much focused on dispersion and trying to take advantage of any potential dispersion in the industry. How do we play that? Today, we're spending a lot of time in areas like TMT, long short. TMT, long short is an area that tends to have a lot of dispersion. The sector has a lot of dispersion, and allocating to specialists who can pick the winners and the losers makes a lot of sense. We also are very keen on thinking about the second and third order consequences of artificial intelligence. So what does that mean? Maybe second order consequences, thinking about energy. You think about what that may mean from an inflation perspective and knock-on consequences. And also, we like the area because it's an area where there's supply-demand mismatches. I saw a stat recently where over the past 10 years, LPs have reduced their capital commitments by 75% to energy private equity. And so when we see opportunities like that, it's a potential opportunity for us to capitalize on, particularly given the universe and the needs from an artificial intelligence perspective. And then maybe the third order consequence, we look at areas like healthcare and biotech. These are areas that tend to have long lead times in terms of development of drugs and so on and so forth. And so thinking about putting some capital behind trends that may take a while for artificial intelligence to help produce the future drugs, we think that's an area right for opportunity and disruption in artificial intelligence as well.
Max, I'll stay with the growth topic. You spent a lot of time in San Francisco. You built CPP's growth equity platform basically from scratch, right? What does frontier investing in your world look like right now?
Yeah, absolutely. Well, first off, thank you very much for having us, Shannon, and the rest of the team here. There's a number of different areas that we're focused on today. We have the privileged position. We're about an $800 billion plan. We have some of the best investors in the world that we look to for signals in terms of where to invest. And then we also use our internal expertise, and we look at different things that we're seeing, whether it's in the real asset space or public market space or credit space, to determine where to focus. Some of the bigger areas that we're focusing on today is obviously AI has been a major focus. When I started the program in 2019, we anchored an AI-focused fund, and so we've really been investing in it the whole way through. Where we see opportunity in AI is, number one, concentration in the winners. So if you look at our biggest positions today, it's OpenAI, Anthropic, Databricks, and we really think those companies will continue to compound. You'll hear from Philippe after this, but Thomas Lafont, if you haven't checked it out, did an interesting presentation where he actually showed that going from a $100 billion valuation to $1 trillion valuation was more likely than going from 10 billion to 100 billion or 1 billion to 10 billion recently, which we thought was interesting and talks about the scale of some of these companies over time. Totally agree with Justin's point on the derivatives around the second order impacts of AI, whether that's energy, data centers. We have a really big investing program around. We've invested in companies like Waymo, which are beneficiaries of what's happening in AI, and so we think that's a really interesting area. The other areas I'll also highlight, so I totally agree on the life sciences point. We have a company like in Citro in our portfolio, which does AI drug discovery, and we think that's a really interesting area. But even outside of the AI applied to life sciences space, we think there's some really interesting things happening. Two of our portfolio companies, Seaport and Xaira, recently went public, and we think there's some great opportunity there. And then lastly, a more emerging area for us is around defense tech. We think this is a really interesting one. Number one, public sentiment has changed around defense tech, which makes it a bit more interesting in this environment. Obviously, geopolitically, there's a lot of need for defense tech out there. And lastly, if we think about this hardware, AI, marrying of these two different areas, it's a little harder to disrupt this area than your more traditional, let's say, down the fairway software type business. So we haven't actually made any investments in this area yet, but we're very close on signing one, and we are spending more time on there just because of how big of a trend it could be.
Mario, I'll stay on this idea of national resilience as well. And what are some of the implications when states are not just consumers but are investors in that theme, whether it's on the defense side or national resilience more broadly?
Yeah, I think you hear me well. Yeah, I think it has become more and more important the last year to revisit how we invested locally from that moment, Liberation Day, I think it was a bit of a wake-up call for all nations in the world, and how, it was not the first wake-up call we've had in the last 5 years in terms of how autonomous we were as economies. So clearly for us, this strategy is falling straight in the middle of the fairway in terms of thinking about infrastructure, how we invest in infrastructure. And in Canada, it's going to be a very interesting opportunity set for us to think about infrastructure. But also, private markets private credit is something that we've been very present, accompanying our portfolio companies. So it'll be a very fertile ground for us to continue to look at across Canada.
And Elizabeth, if we stick with private credit, are you more defensive right now, enthusiastic, opportunistic? What's the broadest for that asset class?
Yeah, and I also just wanted to make one quick comment on AI. From my perspective, I think AI is going to bring winners and losers among allocators. I think that those that don't adopt it very quickly, I'm thinking about those with maybe some hurdles at the state level specifically, are going to be left out. And I'll tell you why. Because if Fortress, for example, calls like your local state and says, we've got a great co-investment deal, but you got to tell us in 2 days, theoretically, someone can do 90% of the work on that at some point and get in 2 days. And then someone else who hasn't adopted those or learned how to use them will be cut out. So I think you're going to see a K-shaped LP happening pretty quickly. On private credit, defensive or conservative, I think now is probably a pretty interesting time where you could potentially do both. Most investors, at least in my experience, don't have the option to be in or out of a complete market. I think the opportunity is setting up for a pretty potentially interesting distressed and opportunistic cycle for sure. Where you put your money to hold it, I think is a little bit more complicated because you could actually be losing real returns if you put it too conservatively right now. But I think in terms of defensive, this is not going to be anything new. But senior secured, senior in the capital structure, those sorts of things are going to matter. Making sure you have a workout team, all the things I promised I wouldn't say 10 minutes ago. But I think it's really a setup for both.
And Justin, most of your clients are really thinking very long-term, decades, not quarters. What are you looking at the portfolio level that might have changed in the last, let's say, 5 to 10 years?
So we are very fortunate at Brothers Harriman to have a unique private partnership model and to have withstood the test of time. We've been around for over 200 years, and it's a privilege to invest at an institution like that. And our clients appreciate that and value that. And so we have a lot of patience that we can capitalize on. In this environment, how that comes to play within our portfolios is that we don't have to invest year to year or even quarter to quarter. It's more about floating to where we think the opportunities might reside over the coming years and decades. And so you think about where we see broadly public equity markets, particularly in the US, the level of concentration that we have not seen historically. You think about valuations at all-time highs, depending on which metric you use. And so we think about history, and you look at the past 15 years, we're getting close to a 15% return, 15 over 15. That's pretty unprecedented. And our capital markets assumption, they're calling for more like a 6.5% return in US large cap equities. So needless to say, we don't think what's happened over the past 15 years is going to reoccur over the next 15. So what does that mean we have to do? That means we have to find asset classes like what we call independent returns. So those investments where we can generate equity-like returns without taking a lot of equity beta. Yes, hard to find, but with skilled investors, we think we can do that. So we're spending a lot of time there. But what does that mean? That means that any given year, we run the risk of underperforming an index if it's up 20%. Maybe those independent return managers are up 10%. And so we have to be very deliberate with our clients about helping them understand the role that those types of investments play in their portfolio. What else can we do? We've been really keen on adding duration within our Muni bonds portfolios. You think about what is it that our average client is looking for. They're ultra high net worth. They are looking to preserve and grow their assets. If you look at what you can get 15, 16, 17 years out in a Muni bond, you can lock in a 7.5% tax equivalent yield. That's pretty attractive for a lot of people. That's really, really attractive. But in any given year, if you pay attention to the volatility, that might not be so pretty. And so taking advantage and explaining to our client base that that is a yield that they're going to receive no matter what, as long as they hold it to maturity, that's the type of investments that we're allowed to do at Brothers Harriman.
And Mario, speaking of volatility, you mentioned that you guys have been spending more time and focus in those hedge strategies that operate well in volatile environments. Can you tell us a little bit about that approach?
Yes. So what we have done, I've been investing for 25 years in hedge funds or liquid alternatives. From just about 2011 till 2020, we went through a bit of a winter. It was very difficult to generate alpha, if you like. And 2022 happened, and I think that this was sort of that line in the sand that made us realize that correlation regimes were changing. There would be more volatility, with macroeconomic data. We talked about that. But also, interest rates were no longer at zero. Volatility was not compressed. And correlation was kind of changing, right? And from that moment, people were still anchored in the fact that we would all mean revert. Didn't happen. These factors were really conducive for good hedge strategies. So macro, market neutral equity, anything that has a lot of dispersion. So this is where we decided to reignite what we have been doing for 25 years in hedge funds. And it's sort of this, I call it a very low duration asset, right? So it's not an asset class, but I call it very low duration because it adapts. It changes its minds when facts change. And we like that, especially in this type of regime. And we've been building on it now for, we've had it for, again, 25 years plus, but this time around, I feel that we are on a more durable cycle for these types of strategies. First of all, technology, managed accounts, cash efficiency. These are all the things that allows us to better implement the same program that we did like 25 years ago. But I feel also that the manager ecosystem is probably more institutionalized. There was not 1 month in the year like pre-Lehman where we didn't have like a reputational risk situation to defend in front of our investment committee. I think that, and let's touch wood that it doesn't start again, but I'm confident that we're probably in a more durable stage. But at the end of the day, this is all interesting, but hedge funds cannot be replicated with an index. So manager selection is key. And I cannot stress that enough. You don't try this at home. You can't be a tourist. You need to know, you need to have like experience in terms of selecting managers because there's going to be more alpha to be made in active management, but at the same time, the range of outcomes is going to be large. You're going to have dispersions between the fourth quartile and first quartile managers in each of the strategies. Yeah.
And Max, Mario is talking about institutionalization, obviously the asset classes and managers that he's focused on, and you've had to build that institutionalization across your organization. How do you work with teams across CPP in order to get the outcomes that you're looking for?
Yeah, absolutely. I think one of the big drivers of this has really been the competitiveness of the market and how the market has evolved. And we've had to really think carefully internally around what our edge is in these different situations. And for us, it comes down to scale and breadth of really what we have to offer in addition to expertise and everything else that we have. the breadth of what we can offer is particularly interesting in this environment as it relates to AI or other opportunities that are out there. For example, we look at the equity of Anthropic, and maybe our credit team will look at GPU financing, and then our data center team might look at a data center that Anthropic's about to use. So we have to underwrite them as a customer, and then they can reach out to us to figure out what the creditworthiness is. And so for us, it's less about duplicating efforts. It's less about attacking the same opportunity. It's how do we differentiate ourselves as it relates to surfacing new opportunities, winning those opportunities, then adding value to these companies over time. It's been an incredibly powerful tool. There's a bunch of ways we try to spark this up internally to make sure across the 2,000 people and $800 billion we manage, there's a lot of interaction, especially when you have 9 offices around the world and people aren't always on the same time zones. We do it both in structured ways, through knowledge sharing, different forums, things like that, as well as unstructured in terms of one-on-one conversations, getting out there. And for us, it really comes down to this one fund mentality we have. It's a cultural thing we've had to build up over time, and it's been incredibly valuable for us, particularly in this market.
And Elizabeth, what do you think are some of the anti-consensus compelling trades right now?
Anti-consensus?
Yes.
Trades? Oh man, I mean, we were talking about backstage how like this is like the hardest question ever. And I don't mind being contrarian. It's just that we have so many people in this room that someone's looking at it. But I would say, look, I would say that for years, everyone was like really focused, at least in credit and in equities, on the software trade and tech trade, and stayed away from the consumer. And I would say we really haven't seen all the negative news play out as much as people really thought about the consumer. And it's not news to anyone here that there are different varieties of the consumer, but like one thing to think about for the allocators is that if everybody's running over to see one show, then they're missing this other one, right? And so you're getting tighter pricing, worse covenants, worse deals when everyone's over in one area. And when you're in another area that you know well, you do well, and you're one of the only people showing up, the risk-adjusted return there and the opportunity there is likely to be somewhat compelling. So I would think about the things that you've kind of trashed. Those are probably going to be the things that are interesting going forward. And like if we're talking about an eventual distress cycle, like some of those software names could start to become interesting too. So I think that's one area. I think other things that will come back, but we've already heard coming back that I've thought for like a year or two now are really interesting, like real estate debt. I think is much underappreciated in institutional portfolios and warrants another look. And I think probably real estate equity too. I wouldn't say like those are unseen, but I would say that there are things that people didn't talk about or were scared of the headline risk that they should really reconsider, because I think the odds of hitting your real return targets over the next 10 years are going to be way more challenging than anybody thinks.
Justin, I feel like a lot of today I've been trying to be mythbuster, anti-consensus, counter-consensus. Where do you think consensus or headlines was getting something right now? What do you think we'll look back on and decide that the market has kind of traded in the way that you would anticipate?
I think some of the volatility we're seeing in markets today, literally today, is reflective of the reality that investors are not conflating a revolution in innovation with not having a revolution in volatility. Those two things go together. It is not going to be a straight line up. And I think that would make me really concerned about a bubble if we saw that complacency of expectation around a linear improvement in innovation without seeing that volatility. But I think there are plenty of conversations happening today that question the amount of, say, spending that some of the hyperscalers are doing that make me believe that the questioning is helpful. And so I think that is something that is somewhat consensus and that investors are grappling with, that lead me to believe that it's not going to be quite at least we're not at bubble stage at this point.
Max, there's consensus think, and then sometimes there's consensus capital flows. Where do you think, is there still genuine alpha in private investing opportunities, or has too much money just frankly gone into the space in the last decade?
Yeah, we absolutely still think that there's alpha today in the private markets. You're correct. More capital has flown there. There's more competition on deals, and the speed at which things are happening are faster than ever. So that creates a more challenging environment and one that you have to adapt to. A few truths that we've long held, which still exist today, are private markets still are inefficient in areas. And so that's where there is opportunity that does exist. Second, we believe the private ownership model is superior to the public one in a lot of instances, in a lot of ways, and allows companies to be able to accomplish things they might not be able to do within the public markets. And so we think that should create alpha. And then number three, we think our long-term investment horizon is pretty key to being able to be successful within the private markets. And those three things, at least combined, along with a bunch of other reasons, we think there'll still be alpha out there. That alpha, over the last few years, and it's been the same in the public markets, has largely concentrated in a few winners. And so getting access to those winners has been key. So our ability to leverage our partners' relationships, be proactive, be there early, and have long-term conviction in a class, similar to what was mentioned earlier, I think is really key to being able to generate that alpha over time.
And Mario, one of the things that we talked about in our prep call was the next generation of certain types of strategies that have been around for a while and were once cutting edge and top of innovation. Do you have any thoughts on what you think the next era of equity market neutral investing, quant investing, et cetera, looks like?
That's a good one. I mean, listen, what's happening with AI and how it will rewire or redesign sort of the floor factory of managers, how they're using AI, how they're enabling these applications to better augment their judgment and everything. And are there any strategies around that? I'm not sure. But I mean, ultimately, what I see kind of still pushing, and I'm not sure it's innovation in 2026, is quant management, the quant process versus fundamental. So we're seeing that trend where quant is more and more taking space versus classical fundamental value investing. So that's something that influences a lot our way of looking at markets and what are the best ways to win, what are the best ways to beat your benchmark, whatever it is, right? So always thinking, I think more and more, I think that we need to think about, so fundamental analysis was always important, valuation's important, but I think that the way forward maybe is how you implement transactions, ideas, and being very creative. So a very simple example, which is not new, but long extension versus long only. So that's, to me, it's just a different implementation to go farther on the extension curve. So I see more of that, I would say.
So we have under 2 minutes left, and the title of the panel is Where Institutional Capital Moves Next. So I'd love to end with asking each of you, where's one place you're going to move money in the next 12 to 24 months?
One thing that has not come up as much that I think is a trend and that we are very much focused on moving capital to is strategies that are deliberately creating tax alpha. Most of our clients are taxable. And I think we are moving to an industry where we are going to have to report and respond to clients who are demanding after tax and after fee results. And so the more that we can be proactive around rotating capital to those types of opportunities, I think the better off our clients and our business will be.
Yeah, I mentioned this earlier, but I do think the defense tech area is a super interesting one. It may follow a similar trend to some of these other AI-like areas where it's concentrated in a few winners, but I certainly think that's going to be a very, very interesting space going forward from an investment perspective.
I'm going to answer a different question. But one thing that I would think people should start watching, if you're not going to be boring like me and watch money supply and velocity, watch how much mortgage basis trading and hedging is happening, because that should continue to put upward pressure on yields as well.
So your question was where the money will move, where I feel the money will move?
Yes.
Canada.
Yeah. Excellent. Well, Justin, Max, Elizabeth, Mario, thank you so much. We have timed this almost to the second and appreciate your time today. Thank you very much.
Thank you.